Hello everyone, how's it going? Welcome to my channel, where we talk about the most interesting and sought after titles in the market. In the world of investing, people are often asking themselves, where is the next big thing, and how to accurately seize the opportunity before it takes off, and how to enjoy safe and predictable income. It is precisely to answer those needs that an ETF like SCHD has been created. It is an ETF that correlates with some of the world's most famous and successful companies and distributes dividends from the stock incorporated within it. To a large extent, the Schwab US Dividend Equity ETF chooses the safest and most stable industries in our economy to invest for the long-term prosperity of all. Perhaps another reason why SCHD has attracted so much attention from the market participants is its price action since its inception, as well as the dividend track record. Over the past 5 years, despite strong economic headwind, the Schwab ETF managed to increase its share price by almost 50%, which in that regard alone has already beaten many of the more riskier counterparties. If we go back as far as 2011, when it first began trading, SCHD increased by more than 183% since its beginnings, which really shows us how far the stock has risen. Before today's video begins, if you would like to see more stock analysis like this one, please remember to like, comment, and to subscribe to my channel. Over the past few days, Charles Schwab Dividend Equity ETF has been trading around the $76 range, which is 6% higher than what it was just a month ago, and 7% compared to where things were just 6 months ago. It's worth noticing that it is approximately 17% higher than the bottom that was found on October 27th at $67, and that level has not been tested since. SCHD has been trading sideways since the beginning of the year, finishing 2023 just 0.34% higher than when 2023 began. It seems like the market is interested in the stock but lacks the motivation and especially the catalysts to see the stock going higher. I believe that it is a decent signal of optimism given how the year has been marked by a continual pressure for lower equity prices across the board, mixed with many concrete signals that the market may be entering into a recession in the upcoming years. Given that SCHD is solely based on the performance of dividend stocks, it means that the demand for such a product remains constant when the inflation reached historical heights and when the risk-free yield of capital is already very interesting. It's worth noting that SCHD has a relatively decent yield at 4%, and that the amount of dividend distributed over time has been increasing. If we compare the yield to other safer products, however, I would argue that the yield may only be part of the appeal. The other part of the appeal may have something to do with the demand side, as the stock is very popular with both institutional and retail traders, which may trigger some very interesting takeoffs in the price. With that being said, let's also take a look at the technicals. The trading volume of Schwab US Dividend Equity has recently been around 3.2 million shares, compared to an average volume of 4.3 million shares. Over the previous 52 weeks period, the price fluctuated between $66.67 and $78.73. Its volume of shares traded tells us how many shares are being bought and sold at any given point in time, and if there's enough liquidity to support a trading strategy. If the float is too thin, it would be easy to influence the stock price but hard to exit. When we compare the current volume against the average volume, there might be the possibility to spot a potential reversal or breakthrough if the difference is significant. For instance, if the stock were to break through, the current volume would be far higher than what the average volume is. The asset under management for Schwab is currently around $42 billion. As we compare the current price to the historical price fluctuations, the stock is 7% higher than the 1 month low, 14% higher than the 3 month low, and 14% higher than the 52 weeks low. On the options market, which often gives us a hint on the market sentiment on where the stock price is likely going to go next, the implied volatility is 11% compared to a historical volatility of 13%. The put-call volume ratio is currently at 32%. It is normal for many stocks to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 2,000 contracts a day versus the 30-day average of 2.4 thousands. In terms of open interest, the most recent volume of open interest is 57 million contracts compared to a 30-day average of 61 million contracts. Regarding the shareholder structure, institutional shareholders hold about 40% of the outstanding shares. The biggest shareholders include Charles Schwab, the Bank of America, and Morgan Stanley. Usually, it is better to see some institutional participation when holding a stock long-term, because it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long term, which is an important factor to consider for the investors. I personally consider the minimum threshold to be around 25 to 30% for institutional ownership. The current short interest is about 0.06% of the total float, 40% of which come out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant portion of the short comes from the dark pool, it may suggest that there are institutional positions taken to short the stock and that there would be potential for a short squeeze. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one: the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. Overall, I would recommend to buy SCHD slowly over time, because as the interest rates come down, there may be a renewed sense that things will be on the uptrend again, and that more capital may come back to the equity side in order to earn a yield. Regardless of the market volatilities, SCHD may be a decent stabilizing element in any portfolio in the long run. I would recommend to commit between 10 to 15% of your portfolio and to recommend to split the allocation in batches of 20% at a time over 3 to 6 months so that you can purchase more in case there's a retracement.